and welcome. My name is Roman Basie. I'm an attorney and CPA, and I'm president of the Center for Financial, Legal, and Tax Planning. I'm also a managing real estate broker and a title insurance agent. Those of you who have took my course before or who are just now listening in for the first time know that my practice specializes in the area of tax preparation and tax planning for individuals and businesses across the United States. So, without further ado, let's get started. So let's take a look now. What we're looking at, and I'm on slide 2, is we're looking at the annual inflation adjustments. And you'll see the paragraph 1.1, section 1.1. And we tell you to look, see revenue procedure 2016-55 for additional information, because that is where the information for this section comes from. And you'll see some of that throughout this session. So let's take a look at our first section, unearned income of minor children taxed as parents' income. This is otherwise known as what? The kiddie tax. We've all heard of this tax before, when a child is earning income and it's going to be taxed at the parent's income tax rate. You know, a funny story for me is back when I was a kid, my younger brother was always known as one of the highest paid lawn mowers in the state, because my father would always pay him an income, and he would be sometimes subject to the kiddie tax and sometimes not. But let's take a look at what it means. So for taxable years beginning in 2017, the amount which is used to reduce the net unearned income reported on a child's return that is subject to the kiddie tax is $1,050. The child's gross income for the year must be more than $150, but less than $10,500. And that's your bracket for the kiddie tax. Let's take a look at the adoption credit. So for taxable years beginning in 2017, under Section 23, sometimes there's going to be more to the sections than what I give you on each of these headings today, but just look under Section 23A3. The credit allowed for an adoption of a child with special needs is $13,570. For taxable years beginning in 17, the maximum credit allowed for other adoptions is the amount of qualified adoption expense up to that limitation. So keep that in mind. But the available adoption credit does begin to phase out for taxpayers with modified adjusted gross income in excess of $203,540. And it's completely phased out for taxpayers with modified adjusted gross income of $243,540. What's interesting about the adoption tax credit is that this has one of the highest phase-out limits of any credit that you'll hear today, or most of the credits that you'll hear today. So keep that in mind, that if you have a client that is in the process of an adoption, that a lot of those expenses can be subject to this credit and available to them because that threshold of phase-out is so high. Okay? Let's take a look now, moving on to the lifetime learning credit. For taxable years beginning in 2017, a taxpayer's modified adjusted gross income in excess of $56,000, as you see there, or $112,000 for a joint return, is used to determine the reduction under Section 25 in the amount of the lifetime learning credit. And when we look at the earned income credit, the earned income amount is the amount of earned income at or above which the maximum amount of the earned income credit is allowed. The threshold phase-out amount is the amount of the adjusted gross income above which the maximum amount of the credit begins to phase out. And finally, if we look at the excessive investment income, we're going to see this a little bit throughout this particular section of the AFTR program. For taxable years beginning in 2017, the earned income tax credit is not allowed if the aggregate amount of certain investment income exceeds $3,450. So keep that in mind. You'll see that again later. The earned income tax credit is not allowed if the maximum investment income exceeds $3,450. That's a low threshold for that investment income. So if you have a client that has some investments out there and they're earning investment income in excess of that $3,450 threshold, be aware they're not going to be eligible for the earned income credit. Okay, let's move on now to slide number 3. And we're still talking about the annual inflation adjustments, and we're on the revenue procedure 2016-55. Now look at section 07, the rehabilitation expenditure, treated as a separate new building, and the amount of $6,700. For the calendar year 2017, the per low-income unit qualified basis amount here is $6,700. So if your client is doing some rehabilitation expenditures on a building, pay attention to that limitation of $6,700 and keep in mind that is per low-income unit. If they're building more than one unit, that may apply to more than one unit. 08 is the low-income housing credit. So for calendar year 2017, the amount used under this section to calculate the state housing credit ceiling for the low-income housing credit is the greater of $2.35 multiplied by the state population, or $2,710,000. And finally, look at the last bullet point on the slide, the employee health insurance expense of small employers. So for taxable years beginning in 2017, the dollar amount in effect is $26,200. This amount is used for limiting the small employer health insurance credit and under Section 45 for determining who is considered an eligible small employer for purposes of the credit. So if you have a small employer that you're representing and you want to look at what the employee health insurance expense of the small employer could be, take a look at Section 45 just to see if that employer fits the definition of being considered a small employer.